and welcome. My name is Suvira Bodha, and we at Amplify Investment Partners are very excited to introduce the third part of this series in educational videos relating to hedge funds. As you may recall, the purpose of the first video of the series was to provide a basic level of understanding about what hedge funds are and how they work, what benefit they bring to traditional multi-asset portfolios, and how an investor may gain access to them. The second video took a deeper dive into the various return profiles of the hedge fund strategies. It focused on how fixed income hedge funds apply their strategies across the yield curve and considered the benefits of different types of strategies. Today, we'll be looking more specifically at long-short equity strategies. We'll take a practical look at asymmetry in the market and consider the benefits hedge funds enjoy that come with added degrees of freedom. Finally, we'll consider the different types or styles of equity hedge funds. To recap, when we think of hedge funds and what a good hedge fund should do, what we look for is asymmetry of returns. Remember this chart from an earlier video. Asymmetry of returns means a portfolio is managed with deliberate effort to minimize the potential downside. That is, minimize the losses in a portfolio. This means that when a market is struggling and producing negative returns, a hedge fund will try to minimize participation in that. Because this manner of investment management is synonymous with careful risk management, protection on the downside comes with some sacrifice in participation in returns when the market is running. Thus, when we're experiencing strong bull markets, the hedge funds will likely lag a little bit in performance. On the other hand, the asymmetry and the low volatility associated with hedge funds provides a smoother return profile and reduces sequencing risk. Let's take a look at a real-world comparison of this. What we see here is a scatter plot of the different hedge fund asset classes versus the return of the Aussie on a rolling 12-month basis. This chart is meant to show us how a hedge fund may perform compared to the Aussie over the same period. Looking closely, we can see that the fixed income hedge funds do really well. Regardless of the Aussie, regardless of whether the Aussie has returned positive or negative numbers, the fixed income hedge funds tend to return positively. This is partially due to the fact that there is a low correlation between fixed income hedge funds and the Aussie. Of more interest is the multi-strat and long-short equity performance. We can clearly see that most of the dots that appear below the 0% on the x-axis, meaning the Aussie performed negatively, the hedge funds outperformed. In many cases, hedge funds were able to produce positive returns even when the Aussie produced negative returns. Let's look at long-short equity in a bit closer detail. When we focus on the performance of long-short equity hedge funds, we can see that the funds have been providing the downside protection quite well. On the other side of things, we can also see that long-short equity funds also do quite well when returns on the market are rather low. This can be seen by the cluster of dots near the origin. But when there's a strong bull market, the return of long-short equity funds start to lag a bit. Consider the relative risk profile of hedge funds versus the broad equity and bond markets. The hedge funds demonstrate much better risk profile relative to the market that we can agree on. It's clear that long-short equity specifically particularly has far less risk than the Aussie, its broad equity comparison. However, the annualized returns are also lower. But when we say this, you must also remember the effect of downside protection and the power of compounding over time. The cumulative chart of returns over the last decade show that even though hedge funds tend to lag in strong bull markets, over time, the protection that they offer on the downside that compounds over time has led to all the hedge fund asset classes outperforming the Aussie, albeit to different degrees. Let's take a look at the added benefits equity hedge funds enjoy. A long-only manager has a limited number of ways he may express his view on a stock. Let's take a very simple example of a fictitious stock that sits before us. Suppose the manager sees the price rising and decides to invest at time 3 when the share price is 100 Rand. If the manager holds the share, he will experience the gain as the share price grows. But as the share price declines, he'll start to lose on his investment. The obvious answer would be to simply sell when the share price falls. But remember, in some cases, managers are compelled to hold certain shares because they make up such a large proportion of the market, Naspers being a prime example. This ultimately means that as the share price falls, the fund will also experience losses. In the long-only world, however, the manager does have some ability to protect himself. He can choose to buy protection to limit his potential downside loss, but this protection will have to be paid for. This usually comes by selling away some of his upside potential. In the case that we see in front of us, the manager has bought derivative protection below the price of 95 rands and paid for it by selling upside potential if the share price ever goes above 115 rand. This derivative protection means that at time 12, a normal long-only holding in the share would have resulted in a loss of about 20 rand, while the derivative protected holding would have faced a loss of only 5 rand, and that's because of the 95 rand versus 100 rand investment protected price. In addition to going long a stock, a hedge fund can also go short. But what does that mean? When a hedge fund has a negative outlook on a stock, they believe that the share price is going to fall, so they can actually go short. Practically speaking, that means they borrow the share and sell it in the market. When the share price falls, they buy it back at the lower price and return it to the lender, having made a profit when the share price fell. Derivatives range from the simplest call or the simplest put option to many exotic varieties of derivatives. In essence, though, a derivative allows you to buy the experience of an underlying asset without actually needing to own it. A call option, for instance, is a derivative which you can buy at a fraction of the price of the stock and can gain you exposure to the growth of that stock over a given price, that given price being the strike price. In this case, for a very small initial investment, a hedge fund manager can produce greatly significant gains. This is very closely linked to the idea of leverage. If the share price ends up falling, the maximum loss you would face is the cost of the option. But if that's the initial investment, there is potential for significant loss as well as significant gain. This is what is known as the effect of leverage on a portfolio. Let's consider what a practical example of these concepts mean. Consider the same fictitious stock we looked at earlier. Suppose as time passes, the fund manager starts to believe that the stock price is way too high and will fall quickly soon. Let's say at time 6, he decides to short the stock. He borrows the share and sells it in the open market for 120 rand. As the share price rises, his position actually moves against him. But as time passes and the stock price begins to fall, and his position will start to become valuable and after a while profitable. By time 10, the manager might start feeling that the share price has fallen enough and is reaching fair value in the market. So he decides to close out his position by buying the share in the open market at 94 rand and returning it to the lender. This short trade has made the hedge fund manager a whopping 26 rand, while his long-only counterpart would have either lost money because the share price fell, or at least not made any money at all because he chose not to invest in a stock whose price he expected to fall. Apart from shorting a stock, the hedge fund manager could have a gained exposure by buying or selling a derivative instrument. Let's consider an earlier time, say time period 1 or time period 2, when the prospects around the stock are still very, very positive. The stock price is rising and the expectation is that the stock price will continue to rise. Instead of buying the stock, the fund manager could buy a call option. This gives him the right, but not the obligation, to buy the stock at a specified strike price. Let's say that at time 3, when the share price is 100, the fund manager buys a call option for a price of 5 rand on the stock with a strike price of 115 rand. This means that if the stock price rises above 115 rand, the manager can exercise his option as the derivative starts to grow in value. At this point, though, when you just bought the derivative at time 3, the call option is still valueless since the share price is below 115. But as the share price rises above 115, the option begins to grow in value, just like I mentioned. If the manager perfectly times the stock, he will choose to exercise his call option at time 7, when the share price in the open market is 130 rands. This means he'll be able to buy the stock for 115 Rand from his derivatives counterparty and sell it on the open market for 130 Rand, making 15 Rand on that sale. Given that he paid 5 Rand for the option, his initial investment of 5 Rand has returned him 10 Rand, which is 100% return, while a long-only manager might have a return of just 30% in comparison in his traditional long-only position. In some instances, the return a manager can generate using this type of strategy is far more than 100%. This is the effect of leverage at play. Of course, this brings up a very big question. What if the hedge fund manager loses more than 100% of my money? It's quite a scary thought, but it's something that we shouldn't be worried about. South African hedge fund regulations limit the amount of leverage a hedge fund can take to protect investors from hedge fund managers that take on excessive risk. South African hedge funds are highly regulated, and risk metrics are monitored on a daily basis, if not an hour-to-hour basis. Let's take a deeper look into the types of equity hedge funds. As a quick recap, the 4 main strategies of hedge funds, as we mentioned in an earlier video, are long-short equity, fixed income, commodities, and multi-strategy. But let's take a closer look at equity in more detail. There are 3 types of equity funds, all of which employ long-short equities trading strategies, but differ in the relative riskiness. Let's consider them from right to left, or most risky to least risky. Aggressive equity funds try to maximize return in all environments. They tend to take directional positions, otherwise known as naked calls or naked puts, and may demonstrate higher leverage than other hedge funds. They may also engage in unique trading opportunities tactically, which allow them to add even greater idiosyncratic alpha. Conservative equity hedge funds tend to take fewer directional bets and would rather express their investment views with a more relative arbitrage type trade. Market-neutral hedge funds are on the far left side and are on average the most conservative hedge fund. They aim to produce positive returns in all market environments while demonstrating very low volatility. The key objective with such a fund is to maintain capital protection. That brings us to the end of this video. We have covered quite a lot, but there are a few points that are worth repeating. Hedge funds are an alternative asset class that aim to provide asymmetric return profile. Hedge funds are afforded a wider tool set which aim to create value for the investor. The greater degrees of freedom come in the form of short selling, leverage, and the use of derivatives. Long-short equity hedge funds are arguably the most unconstrained subset of hedge funds, and as such may demonstrate riskiness across the wide spectrum. Thank you for joining us today, and for more information, please visit our website.